With 3 years of S&P 500 growth behind us, are investors bullish or bearish for 2026?
The information presented on this program is believed to be factual and up to date at the time of its recording. We do not guarantee its accuracy, and it should not be regarded as a complete analysis of the topics covered. The opinions expressed in this podcast should not be considered a solicitation for the purchase or sale of any security. This podcast does not contain a recommendation, offer, or solicitation to buy or sell securities, or to enter into an agreement for investment advisory services, and does not constitute investment advice on which any person should or may rely. This podcast does not involve the rendering of investment advice, personalized or otherwise, but is limited to the dissemination of general information. Investing involves risk, including possible loss of principal. A professional advisor should be consulted before implementing any of the options presented. Measured Wealth Private Client Group is registered with the Securities and Exchange Commission and only transacts business in states in which it is registered or exempt from registration.
Welcome to Financial Futures, a Measured Wealth podcast powered by the team at Measured Wealth in beautiful Portsmouth, New Hampshire. Each episode, we're bringing you fresh insights on retirement, investing, and everything you need to take control of your financial future. Whether you're preparing for retirement or already living it, we're here to help you make informed choices with confidence. To kick off today's conversation, here's your host, certified financial planner and chartered financial analyst, George Zaharopoulos.
I'm speaking today with Ed Miller, Chief Investment Officer of Measured Wealth in Portsmouth, New Hampshire, for some insight into market drivers for 2026. Ed, we're just going to dive right in. There's a lot of excitement, and yet there's also some trepidation going into 2026. What's kind of driving both of those?
Thank you for having me. Glad to be here. I would say it's probably just, given the last 2 years of the gains, it's just carryover, that optimism. I mean, the AI bubble, if you will, continues to expand. Although, I mean, I will say, and I wrote it on a recent letter up on our website, you are starting to see, possible fracturing of the Magnificent Seven, those seven stocks that are closely aligned with AI. And they seemed, there was a time when they were all sort of moving together and driving the market. And I sent out countless, examples. It's not just me. Everyone has cited just how much they've dominated the market. And pretty much if you haven't owned those seven stocks, you haven't outperformed the S&P 500 most likely. But they're starting to fracture.
Well, you bring up an interesting point on artificial intelligence. What are the positives that could come from that?
It's almost an endless list. And I think that's really what's driving, this bubble is, as typically happens with bubbles. I, made it through the 2000 internet bubble, and I see similarities. Not so much the 2008 Great Recession, that was different, but the internet bubble, because at the time, what is this internet? Now, of course, you couldn't live without it. But at the time, it was very new. And you didn't know what it could mean for the future. But everybody at the time, sky's the limit. It was going to change beyond even, what we're seeing even today, arguably. Eventually it did change everything. But the expectations that were baked into the stocks at the time were just off the charts. And we're seeing arguably something similar now with AI. Mm-hmm. It is going to change the world as we know it, but is it going to do it at the speed and with the impact that is already baked into the stock prices? That's the real risk.
Right. And artificial intelligence, AI, will likely mean lower costs for a lot of employers, a lot of companies out there, and that might increase their bottom line, which is kind of what's propping up the markets. That's the narrative, the theory. So earnings growth, a lot of analysts are projecting earnings growth to be solid or better than expected. But what's the risk here too? You mentioned that the return on investment doesn't play out. What could that mean?
Again, back as with the 2000 internet bubble, a lot of this, and this current bubble, if you will, are driven by belief. It's really belief. And if the second the belief becomes doubtful, that's the risk, because it's not a house of cards per se, but it's all being propelled by this optimistic, arguably overly optimistic belief. And the minute that becomes less incredible, and actually has some problems to it, the valuation on the stocks will probably get pulled in. There'll be a recalibration of value on these stocks. And that's what happened in 2000. There was a big recalibration of value, and then that's why you had the 2001, 2002 stock decline.
There's definitely a lot of CapEx spending by these major firms. Can they afford it?
There's massive amounts of, potential loans at these companies. I mean, Oracle is the one that's in the headlines these days. They pledged to, I don't know what the number was, $100 billion, that they're going to invest in this with their quote unquote partners, OpenAI and NVIDIA. That they're all sort of getting in bed with each other, if you will. But if you look at the CDS, the credit default swaps for Oracle, and CDS credit default swaps are basically insurance on debt. So somebody's looking to, back up Oracle's debt. Well, if you look at the CDSs they trade, they just go straight up. It's spiked, which means investors are having real doubts about whether Oracle can afford to take out all these loans. I mean, they've recently gone cash flow negative. You could argue that's a one, chink in the armor, so to speak.
Yeah, and I think AI, too, is spilling over to other areas of the market, commodities, precious metals, gold, silver, platinum, have had a tremendous year. There's a lot of demand because of artificial intelligence, and, I'm guessing that might continue in 2026.
Yeah, it's interesting. I was just reading, you talk about flowing over into other industries. So the other risk, there's several risks, but the other risk to AI, given where we are, is it's tremendously power hungry. It needs to be fed tremendous amounts of power. And currently our grid in the U.S. is not up to snuff for what's projected in terms of demand. I mean, we could possibly see next year brownouts. So, Google, they're all aware of this, NVIDIA, all the AI companies, and they're doing what they can to build their own power availability, usually by way of solar panels or wind power, that they can have locally right there at their data centers, so that they become self-sufficient and not have to, tap into the grid. So it's interesting because that kind of innovation, I have a feeling like the space program, how many things do we have because of in the 1960s, NASA going into space? We had all these products that were a fallout from that. I have a feeling, these companies are going to be, spending so much on this energy that in the end, it's going to help the country.
Yeah.
It's going to be clean energy. They're not going to tap into, what we need, as consumers in the country. So, I mean, that's just an example that as an area that's going to benefit.
Right. And just back on those precious metals too, gold, in addition to AI kind of driving some demand for gold, central banks are also driving up some demand for gold. Are they looking to increase a safe asset?
That's the way I'm looking at it. I mean, China in particular, based on my reading, I think there was some lessons, with Russia, invading Ukraine, and then they seized a lot of Russia's dollar-denominated assets. So I think China looked at that and thought, we're going to transfer our reserves into gold, as opposed to U.S. dollar denominated. This way, depending on what they do, it's going to be shielded from sanctions. So that's possibly a motivation, given the geopolitical, picture today. But also there's real interest rates. So what are real interest rates versus nominal interest rates? Nominal interest rates are the rates that you see quoted everywhere. Real interest rates is that rate minus inflation. And so when you have real interest rates that are getting near zero to even negative, that helps gold. And we're seeing that now all year. Inflation has remained, elevated. Let's call it 3%. I think the 2-year yield is 3.5%. So the difference is 50 basis points, half a percent. Well, that's the real rate right now is, arguably 50 basis points positive. But real rates over time, decades and decades, have averaged 3.8%. So it's been going down and down all year. And that is a reason that gold has been going higher and higher.
Yeah, and with the increased demand in gold, it seems like the U.S. dollar is weakening at the same time. There's some good things for that, for U.S. exporters. That helps with foreign nations being able to afford U.S. goods, but not necessarily that great for consumers in the U.S. But what do you see happening with the U.S. dollar?
So currencies trade more in relation to this relative strength of the country's economy versus all other economies. So when the U.S. dollar is trending higher, it's typically reflecting that the U.S. economy is stronger than other economies around the world. And this year we've seen it, the U.S. dollar, it's down, I think, 10% on the year. You could argue, and we have seen the economy slow this year, based on the data we're seeing. Meanwhile, the European economies, you could argue, are doing better. Their inflation's lower. They've been cutting rates more vigorously than we have. And I think that the weakening dollar is reflecting that, the expectation that possibly the U.S. economy is not going to be, at least currently, the place to be anymore. Yeah,
with all of the dollars that we're importing being paid to foreign nations, with the increase in gold, it seems like other nations are trying to depend on the U.S. dollar less as that reserve currency. I think that would be a slow and gradual move that would take many years to take place. But with those U.S. dollars, are they kind of just converting that to other currencies or buying gold with those U.S. dollars?
That's a good question. I don't know. I know that the U.S. dollar has long been targeted to be replaced as the reserve currency, but as you said, that's such a long shot. It's so, so dominant. Even despite the weakness, and I will say that the weakness this year, if you look at the longer term yearly chart of the dollar, it's still within an uptrend that dates back to 2011. And we've gradually, I think we've talked about this before, a weak U.S. dollar benefits non-U.S. stocks over U.S. stocks. So as the dollar weakens, you want to increase, assuming the trend continues, you want to increase your allocation to non-U.S. equities, which we have gradually. But again, I think the dollar's still within an uptrend until, you see more of a, demonstrated breakdown. We won't necessarily aggressively increase our non-U.S. allocation, but we're ready. I'm just sort of waiting for that to happen.
Well, you bring up a good point about the weaker U.S. economy. I know job growth is weakening. There's definitely some policy uncertainty, and I know that the U.S. debt has also increased in 2025. So that hasn't been coming down, but that's certainly a cause for ex-U.S. Foreigners investing in the U.S. And with the potential of interest rates, which you had mentioned, the Fed possibly reducing rates going into 2026 and, maybe pressure from the administration to reduce those rates and a dollar weakening, a lot of foreign capital is not going to flow into the U.S.
Yeah, you talk about the Fed. They've been in a pickle. On the one hand, their dual mandate is unemployment and inflation. That's supposed to be what they focus on. And unemployment's been going up for months. It just hit a new multi-month high recently. And inflation is remaining stubbornly high. So on the one hand, with unemployment going up and the economy slowing, typically the Fed wants to cut rates. But meanwhile, the tariffs are in place, inflation remains elevated. You typically raise rates when you have high inflation. So in the end, what Powell is doing at the Fed seems to be cutting 25 basis points, little cuts month, with each meeting, and then, looking to see from the data how that's worked. And speaking of which, the data, so you had the government shutdown, so there's missing data. So that doesn't help. The market, in some respects, is falling blind. So interesting times.
Absolutely. Interesting. Back to the U.S. dollar, generally speaking, the U.S. dollar and the cryptocurrency, Bitcoin, move in opposite directions, but both are down this year. Do you follow Bitcoin at all?
I do, but not in a serious way. I do because I know clients are interested, and frankly, I'm interested in in it myself. It is an investment vehicle, so I try to keep an eye on it. I know from the peak this year, it's down 30%, which technically is a bear market. Anything less than 20%. I did look at gold, which seems to be the one that's pitted against Bitcoin. The two of them, I think Bitcoin, you could argue, is trying to replace gold as a safe haven or a place to be, if you want to, go risk off, so to speak. But I looked at the returns for both of those going back 2 years. And gold pulled ahead recently. It's up about 120% in the last 2 years, and Bitcoin's up about 100%. So they're close. But if you look at the volatility of Bitcoin versus gold looks like a utility compared to Bitcoin. I mean, Bitcoin is all over the place. Right. So, two things. To me, it's a trading vehicle, not necessarily an investment per se. At least in terms of measured wealth and our clients, I have yet to have an appetite for that. We own gold. Yeah. And that's been fine.
Right. And just to mention, gold is not a safe asset. It does fluctuate in value.
But as the rates go down, that helps gold in a relative sense. But what else does it help? It helps utilities. It helps, anything that's sensitive to interest rates. The problem is that when the Fed starts cutting, significantly interest rates, at least initially, it's not good because it's a sign to investors that the Fed sees the economy is in trouble. And so stocks tend to probably decline before the benefits of the stimulus, which is what happens when you cut interest rates. It's stimulus. Until that finally benefits, you have that short-term pain of stocks probably taking it on the chin.
And if the Fed makes some reductions in 2026, it might not be that major. They could be minor changes, which may not have that big of an impact on fixed income. And, the return there could be simply the coupon. However, the shorter term rates have been going down. So there's been a little bit of a steepener there.
Well, all right. So if he's going to cut rates and the stock market, let's say, declines, that's going to help the bond market. Not only because interest rates going down do help bonds, but people will leave stocks if they're declining and go for safe haven in bonds.
I was surprised to see the credit spreads on high yield still where they are right now, under 3% roughly. I know there was a little bit of movement earlier in the year when tariffs came into play, but those are still pretty tight.
They are tight. People smarter than me have scratched their heads wondering, because again, you are starting to see some holes in the, there are some worrisome things going on, and yet you don't really see it in high yield bonds, which typically in the fixed income market is the most sensitive to that type. High yield, some people regard it as junk bonds, whatever.
So were you surprised to see all of those upbeat, optimistic outlooks by Wall Street analysts for 2026?
No, and I just, not only are they all, so I don't know how many there was like 10 major houses. The strategists, this time of year, they put out their guesses for next year. And from the article I read, they were all positive. None of them had a loss for next year. And even more so, they are all tightly clustered, which tends to, it's not like one's shoot to the moon and another one's moderate. They're all tightly clustered in their projections, which, tends to suggest that these strategists are almost overly confident and certain about what's going to happen next year, which, how that means contrarian wise in the market. When everyone lines up on the same side of something, it's usually not going to happen.
Right.
So all of those bullish strategists, I know that it makes people feel good, but the fact is you shouldn't. It would have been better for them to all be bearish.
Right. Because if everyone's on the same side of the fence, that could all of that could already be priced in to the market.
That's right.
Okay. We talked about a number of different themes today: AI, interest rates, precious metals, commodities, currencies, Bitcoin. But, how are your core portfolios kind of taking those themes into consideration?
Well, it depends on the portfolio. The core portfolios are going to be a little less aggressive, if you will, than what I call the satellite portfolios, which hold individual stocks. But in any case, they've been, I would argue, defensive. Like I said, we own gold. But, healthcare is a big holding. It's starting to work. And, things just along those lines. Tech, we've been underweight. So we're sort of, if you will, getting ready for, unfortunately, what may be, some tougher times for stocks. We'll see. I mean, we were early, but when you have bubbles, that's the timing of it. If you are in the bubble and you hold those Mag 7 stocks, congratulations, you just ride until there's a break.
Right.
But the timing of it is always really difficult.
Absolutely, yeah. And I think, one of the key questions that I deal with on a daily basis, or that I hear from clients, is, how some of these themes are going to affect them, especially when they're nearing retirement. And the biggest thing, one, is to have a portfolio that's globally diversified, so you're positioned to take advantage of those themes in the event they play out, but also be mindful of your risk tolerance and your cash flow needs, because that really drives your asset allocation and could help with a softening of the economy in a down market, especially in times when you're withdrawing funds. So Ed, really appreciate you weighing in today, and really appreciate you joining. And thanks, everyone, for tuning into Financial Futures, a Measured Wealth podcast. If you enjoyed today's episode, be sure to follow or subscribe on your favorite podcast app so you never miss an update. Want to learn more or get in touch? Head over to measuredwealth.net, where you'll find prior episodes, helpful financial planning guides, and more. You can also call us at 603-431-1444 or email at info@measuredwealth.net. That's info@measuredwealth.net. Thanks again for listening, and remember, the future will someday be the present.